So let's talk a little bit about how you're going to finance your rental property. In other words, how are you going to buy it? Now, there are a few ways you can go about this. If this is your first or second rental property, most likely you're not going to be paying for the whole thing in cash. If you are, well, then you could just skip this whole section altogether. Now, I will tell you in all honesty, if I had the money to buy a property outright, I still wouldn't. I would go buy 5 to 10 properties and have a loan on every single one. Not even joking. As backwards as that may sound to some of you, leveraging debt is the key to building true wealth. Now, I could have multiple courses on just this subject alone, but for now, you'll just have to trust me on this one, okay? So back to the financing discussion. The main thing to decide on is how you're going to cover your initial investment or your down payment. So first, you can self-fund the down payment. So if you have saved up enough money in your bank accounts to cover your initial down payment, closing costs, and reserves, hey, my hat is off to you. You've done a great job getting to this point, and that deserves some recognition. Maybe you've even sold a home or a property that you own recently, and you have the funds ready to go. Now, most individuals don't have tens or even hundreds of thousands of dollars sitting in their bank account just waiting for the right investment to come along. But what many of you do have is equity. So if you currently own a home, even if you currently still have a loan on it, you most likely have equity that has been building with each mortgage payment that you've made. In fact, if you've bought your house in the last 2 years, you probably have a bunch of equity that has just magically appeared recently. Now, with home values skyrocketing over the last couple years, it has been absolutely wonderful for those who are already in a house. So basically, the value of the home that you paid for X amount of years ago is now just worth a lot more just because of what's going on in the housing market. So let's use some numbers for the next few examples. And first, let's define equity. So equity is the difference between what you owe on your home loan and what your home is currently worth. So if you own $300,000 on your loan and your home is worth $500,000, then you have $200,000 in equity. So what does that mean for you? Well, that means that you may now have the ability to access that new equity to purchase your new investment property. So how is that done? Now, there's a couple ways you can use or leverage that equity to fund your deal. First is the cash out refinance route. A cash out refinance allows you to take out a loan on the current value of your property. You can generally take out up to 80% of the total value that your home is worth right now. So some lenders will even allow you to go up to 90%. So in that last example, we had a property that was valued at $500,000. You can refinance up to 80% of that. So you can refinance with a new loan up to $400,000. Since your current loan is $300,000, that gives you $100,000 to take out as cash. This is a great option for many investors, although some of you may have financed your home at an amazing rate not too long ago, maybe even in the twos, and you're afraid of touching that loan. For those of you in that position, there is another alternative: home equity loans and lines. So first, let's talk about a home equity line. A home equity line of credit, or a HELOC, is a very popular product. It's useful for not only funding a new investment, but it can also act as a great financial safety net. I recommend that every homeowner have one, period. They should have one in place, whether your intentions are to invest or not. So why are they such a popular product? Well, first of all, you only have to pay interest on what you actually use. So for example, if I have a HELOC for $180,000 and I decide to pull or draw $3,000 to handle a family emergency, I only pay interest on the amount I pull out. So in this case, I only pay on the $3,000 portion, not the full $180,000. Other great features of a HELOC are most times they have a 10-year draw period, which means you have those 10 years to pull and use those funds whenever you need them. And you have up to 30 years in total to pay it off. Another great feature that most HELOCs can actually be refinanced at the end of that 10-year draw period to a new 10-year draw period. So one of the best parts of the HELOC, again, is you do not have to touch your existing home's loan. So if you do have that great rate, that 2% or even that low 3%, now that rates are starting to go up, you don't have to refinance into a potentially higher rate for your entire home loan. So let's look at our example that we had in action. So just like when we calculated the cash out refinance, HELOCs can usually be calculated with up to 80% of the value of your home minus what you currently owe on your current loan. So we have that $500,000 home. We have a $300,000 mortgage loan currently. You're eligible for a HELOC for up to $100,000. Although you absolutely do not have to take out the entire full $100,000 unless you want. It can be less if you wish, but remember, you are not paying on the amount of the HELOC. You are only paying on the amount that you take out. So that's a home equity line of credit. A home equity loan is based on the equity of your home as well. But unlike the home equity line, you actually receive all the money up front. Okay, so you're not drawing from it as time goes on. You get it all up front. So instead of being able to draw from it time to time, you get all the proceeds of that loan in one lump sum. So you then make monthly payments of principal and interest for the entire life of that loan, usually 30 years again. So it would be just like you would in a fixed rate mortgage. Now, I know this is a section about financing your deal, but there is one other thing that I wanted to discuss really when it comes to what do you do and after you purchase it, how do you hold the property? So really, how are you going to hold the title? Meaning, do I keep the property in my name or do I potentially put it in the name of a business? So for myself, each one of my properties is held by an LLC that I have created. Not only does this have its tax advantages, but it also protects me and my family legally. I take good care of my properties and my tenants, but if anything catastrophic were to happen, I wouldn't really want people to come after me or my assets or even my personal home. Creating an LLC that owns the property is the best way to do that. In fact, even my LLCs are owned by my trust. So I have an additional layer of protection there. Now, there are many different schools of thought on this, and my recommendation would be to, speak with your tax professional to help set you up in the best format for you and your situation. That might be holding it personally, just in a trust, an LLC, maybe an S corp. But one thing I would definitely recommend, out there is to at least set up a trust for yourself personally. If you own a home and maybe you even have a family, kids, you should absolutely have a trust in place.